Today, we are building a roadmap to your very first rental property. This is your blueprint for getting an asset that can literally generate income while you sleep. So let me ask you this. Do you think you need a six-figure bank account just to get started in real estate? It's probably the single biggest myth out there holding people back. This idea that you need a huge pile of cash just to get in the game. A lot of would-be investors get stuck right here, thinking it's some exclusive club they just can't afford to join. But here's the truth. The key isn't having a massive bank account. It's having a smart financing strategy. You see, this is a game that's won with knowledge, not just cash. So let's dive in. We're going to break this down into 5 key stages. First, we'll bust that entry barrier wide open. Then, we'll cover how to finance it, how to find the right deal, how to avoid those classic rookie mistakes, and finally, how to understand your taxes.
You know, the biggest barrier isn't really money. It's perception. It's that feeling that this is all way too complex or just totally out of reach. We're going to replace that feeling with a solid plan, and that plan starts with a single most important key: understanding your financing options.
So how do you actually pay for this thing? Well, the best financing for you is going to depend on your specific situation, your credit, what you've got in savings, and what your long-term goals are. There is no one-size-fits-all answer, but there are some absolutely fantastic tools out there.
Okay, this is where you learn to use what investors call OPM, other people's money. Now, a conventional loan, that's pretty standard if you have good credit, but check out the FHA loan, as low as 3.5% down. It's an absolute game changer for house hacking, where you live in one unit and rent out the others. And for all you self-employed folks, the DSCR loan is brilliant. It qualifies you based on the property's potential income, not your personal tax returns.
What's so interesting here is the totally different mindset. A conventional bank cares about you, your income, your credit score, your ability to pay for the next 30 years. A hard money lender, they care about the asset. They are betting on the value of the property itself, which is why they can move crazy fast, sometimes closing in just a week on a fix and flip project.
All right, so you've got your financing pre-approval in hand. Now for the really fun part, the hunt. But remember, a great deal isn't just a cheap house. It's the right house in the right market.
So what makes a market the right one? Well, you're looking for a mix of things. Take investor Rose Hand, for example. She landed on Las Vegas. Why? She did her homework and learned that its economy had grown way beyond just tourism. It had landlord-friendly laws, and, this is a big one, its property taxes were way lower than other places she was looking at, like Dallas.
Now, before you even think about making an offer, you have to do the math. Does the deal actually cash flow? You start with a realistic rent, subtract your mortgage, and then, and this is super important, don't forget all the other costs: taxes, insurance, and always budget for a property manager and for those times the property might be empty. If that number at the end is positive, you might just have a winner.
And here's the real secret sauce. Spreadsheets are critical, but they don't tell you the whole story. The real insights come from people. You've got to talk to local real estate brokers, property managers, and other investors in that area. They'll give you the on-the-ground truth that you just can't find online. Okay, so your team on the ground confirms it's a winner and you've closed the deal. Congratulations! Now the real work begins: management. And from here on out, success is less about what you do and a whole lot more about what you don't do.
Veteran landlord Chris Haskins has some brilliant, hard-won rules. The first one is a mindset shift. When you're talking to tenants, you're the manager. Why? Because a manager can always say, "I need to check with the owner." It creates professional distance and saves you from being pressured into a decision on the spot.
Next up, a super simple rule that will solve a massive headache. No personal checks. A bounce check costs you fees, time, and stress. If you only accept guaranteed funds like a money order, you eliminate that entire problem from day one. It's a no-brainer.
Okay, this is a pro tip most beginners never even think about. On the first of the month, all your tenants' other bills are due. By making rent due on the 28th, you get your payment before it has to compete with everything else. You're putting yourself at the front of the line. Genius, right?
And finally, think long-term. The most wear and tear on a property happens during turnover, when tenants move in and move out. A 3-year lease means more stability, fewer vacancies, and a property that stays in much better shape.
All right, let's talk about the part that can feel a little intimidating, but is actually one of the most powerful wealth-building tools in real estate: taxes. Seriously, understanding this stuff is key to boosting your bottom line.
Basically, your entire rental business gets reported to the IRS on one main form, the Schedule E. This is where you add up all your rental income for the year and, more importantly, where you get to subtract all of your costs.
And here's the best part. The IRS lets you deduct nearly every single legitimate cost of owning that property. We're talking the big ones, like mortgage interest and property taxes, but also things like repairs, insurance, and a powerful non-cash deduction called depreciation. Think of it as the IRS letting you expense the theoretical wear and tear on the building over time, even if you didn't spend a dime on it that year. It's huge.
But, and this is a really big but, there is one absolute non-negotiable rule. You have to keep meticulous records. Every receipt, every invoice, every single bank statement. Good records are your best friend if you ever get audited, and they are the key to making sure you claim every single deduction you are entitled to.
Which brings us to the final, and maybe the most important takeaway of all. While research and planning are absolutely vital, they can also become a way to procrastinate. You can read every book, watch every video, but the real learning, the kind that truly sticks, only happens when you get in the game and take action.
So look, we've busted the financial myths, we've laid out a path for finding a deal, shared some pro tips for managing it, and we've demystified the taxes. The path is a lot clearer now. The question is no longer, can I do this? It's, what's the first step I'm going to take?